Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Nate Tobik on the line. He's an investor and founder of CompleteBankData.com. Nate, how you doing this morning?
Doing work very well. Thanks for having me on again, Joel. So appreciate being on here as always.
All right, so you have different ways to analyze, bank stocks. We had the stress test. It looks like everyone came through for, on the most part, pretty well. What are you when you're analyzing bank stocks right now? What are you focusing on?
A great question. So I look at a couple different things, but I think you could break down bank stocks into really two or three things drive value for banks. So that's their net interest margin, and that's what they're earning on their loans minus what they're paying out on deposits, their expenses, and then their operating costs. So if you kind of think of an equation, it's net interest margin minus their operating costs, and that's essentially their profit. So you kind of have those different levers to work with. So with this the low rate environment, I know there's been a lot of talk about bankers saying they're really being squeezed, and there's just no room to make money. Of course, we know this isn't true, and so we spent some time looking at net interest margins now the fourth quarter data is in, and was just really curious to see what do the numbers say versus what the common narrative is. And so looking quarter over quarter of this is all the banks in the U.S., not just publicly traded. There was 3,897 that actually had net interest margins that were growing, and 2,527 that were shrinking. So the majority are growing versus shrinking. And then if you look year over year, the number's even more exaggerated with about 4,500 growing net interest margins and 1,800 that were shrinking. So, for that common narrative of the low rates are really killing bank profits, there's been a lot of banks, and the vast majority, that have found a way to make money in this environment, and not only just survive and make money, but to actually grow. And they're doing this by cutting deposit costs, which is one, and but the majority is really loan growth, and we're seeing a lot more loan demand as the economy is really picking up, and that's helping banks even though rates haven't ticked up yet.
So if we're going to talk about, banks and their net interest margins and how they make money, then it's all tied to interest rates. And you've been talking about the research that you've been doing. You found a majority of the banks in the U.S. have positioned themselves for rates to rise in a year. What are you seeing in the banks that gives you this kind of intuition?
Right. So one of the things we have with Complete Bank Data is really granular bank information, and so inside there you could look up details on banks' loan books, and so we were able to run some stats on the loans of banks, and when loans reprice, and most banks, they're repricing a significant majority of their loans in under a year. So we're going to have this event where banks need to roll their loan book, and they're keeping it very short term because bankers are convinced that rates are going to rise, and they've been convinced in the past. We've heard this last couple of years. So their actions are lining up with what they're saying, but it's kind of a bet on what actually happens, and we'll see how it turns out.
How much are interest rates going to go up? I mean, realistically, I mean, even we got some of the data today on the GDP. I mean, is there anything that impressive? Unemployment, yeah, it's coming down. You're not figuring, the whole participation rate. I mean, really, how much can rates go up? And also, if rates go up even incrementally, the effect that it has on the U.S. debt and the U.S. debt market, I don't think this is something that that our economy can withstand.
That's a great point. So the numbers I've heard are most people expect about 25 basis points, and the outlier case would be maybe 50 basis points. And that's not really going to move the needle for most of these banks. Uh, I think it's a crutch to talk about that for some bankers because they're hoping that we get back to 5 or 6%,
Huh.
and
No way. No
it's not going to
way.
happen. And they want that because they can't figure out how to make money. They need to rethink their business, and that's the problem. Is banking has changed dramatically in probably the last 10 years, especially with the emergence of technology. And the old model of setting up branches all over a city, advertising, and waiting for people to come to you has changed. Now people are banking on their phones. The millennials are never setting foot into a branch, and just sitting and waiting for what is essentially now retirees to come in. That's not going to move the business forward.
Right. Yeah, that's a great point. I mean, people I talked to the kids here in the office and stuff, and one time I mentioned something about a check, and they're like, "What's a check?" They never a checkbook. I mean, they do everything online, so that's a great point. Let's talk about some regional banks here. Let's get into some specific issues here, and the regional banks are sometimes look, take over targets or whatever. Let's just get a couple comments here on some regional banks and how they're holding up in this interest rate environment. Let's start with FITB, Fifth Third Bank.
Sure. So of all the regional banks, really the two that stand out is Fifth Third and SunTrust as being the most undervalued. And all these regional banks have the same tailwind behind them, which is that they're in the sweet spot. They're not community banks, so they have enough size and enough scale to grow. They're a lot of times very innovative with the technology. So to what I was saying before with the branches, you see banks like PNC and Fifth Third doing that. You could deposit checks on your phone. They're closing branches, going to these mobile branches. So they're on the forefront of a lot of this stuff, and the shares are still undervalued. So we have a price on Fifth Third of saying they're worth about 25 a share, and they trade for a little over 19 right now. So that's a some pretty good upside, and that's if there's no growth, and that's not what we've been seeing. So if there's some growth to where earnings are coming in going forward, I think this stock could run a little bit more. SunTrust, the model puts them, maybe they're worth about 50. They're trading for 40 right now, and so that's another. These banks both have good tailwinds in the industry, and they're not going to be the ones that lose out with the increased regulation is a cost burden, and they're not going to be the ones losing market share. They're actually taking market share as the whole industry changes. So the regional banks are a real good sweet spot.
Wow, I'm just looking. I mean, this is a wild child here for like a bank stock. You had the big sell off at the beginning of the year, and then a monster rally back. I mean, this is pretty volatile for a bank stock, huh?
Yes, yeah. A few stocks have gone through some real gyrations like this, and at the end of the year, we saw just people weren't sure what was going to happen in 2015, sold off the banks, and then realized that all they did was turn the page in the calendar and bought right back in, and it's really been a wild ride.
Okay, I'm gonna throw one at you here, and if you know this one, then you really know your bank stocks. I'm from Monroe. This is the only bank stock that I've ever invested in. I'm out of it now. Monroe Bank and Trust, MBTF.
BTF. Okay, let's see this one.
This thing's been around since the Civil War.
Yeah, yeah. Well, so I mean, I just pulled them up, and you know, so we have them as they're slightly undervalued by they're worth maybe $6. They're trading for about 565. But I think this is a great example of just kind of a common community bank, and this is what a lot of the community banks are like. So they've, 5.7% return on equity, and it looks like they have about a 77% efficiency ratio. Their non-performing loans are under control. And so this is the bread and butter of the US banking industry. And there are literally thousands of banks, just like Monroe Bank and Trust, that they're profitable, they're running a good business, but their problem is they're limited to a small geographic area.
They're not
And
going to grow. They're not.
yeah,
Yeah. Where's the growth? Right. Right.
yes.
Okay.
And so growth for them really comes through mergers and acquisitions. So at some point, either they will decide to start buying competitors, local competitors, or the executives are going to decide they're tired of banking, they want to go do something else, and they're going to sell. And that's where a lot of growth is really coming, is these smaller roll ups.
Yeah, no, I don't think those old fogies are ever going to sell. I think they've had probably the original ancestors, the people that started the bank, like in around the Civil War. But before we let you go, let's just talk about some of the big boys. Your Bank America, your J.P. Morgan, your Citigroups. Bank America, big sell-off since the beginning of the year here, from 18 to 15 and change. Any reason to get excited about Bank America, BAC?
I not really. I'm not too excited about them. They had some issues with the stress test. I think there's this narrative about them that they're still recovering, they're still rebuilding their business. Once all these issues finally get out of the way, then earnings are going to be off the charts, and it's going to be kind of a rocket to the moon. Part of me feels like maybe there's some regulatory punitive damage type of a thing where maybe they aren't able to get past some of these issues because someone doesn't want them to get past some of the issues, maybe paying for some of their past sins. And so that people keep waiting. We're still waiting. I had seen about a year or two ago, the estimates would be that this would be around $20 a share now. So we're at 15, about $5 a share short. Now that's that. Well, they'll be at 20 in 2016 or 2017. So, yeah, I would say the better value is really in the regional banks or the smaller banks. The large banks over the last year, their earnings shrunk slightly, whereas small banks actually grew their earnings. So, I think that's where the excitement is once you step down from the biggest banks.
Okay, before we let you go, is there anything, where you're putting your money in the bank, or any investments here, anything on your buy radar?
Yeah, so I'll name a few. So this is a couple smaller banks that are interesting. One is NRIM, North Rim Bancorp. So they're up in Alaska, and this is a good community bank. They purchased a competitor recently. They're growing. Just a nice solid community bank. Another interesting one is OFG Bancorp. That the ticker is OFG for that one. The same thing. This is a little larger community bank, and they're just it's a solid company that it's got good metrics, and I think they're going to continue to grow.
And one more other thing before I let you go. I mean, just figuring in, I don't know how this is going to affect your American Express, your visas, but, Apple, coming in with the Apple Pay, and, I guess that's just a function of the banking system. Who are going to be the winners and the losers from Apple Pay?
That's a great question. Apple Pay is interesting. I think the losers are going to be someone like American Express, who has their closed network or Discover card. So the banks they're gonna do well with this, because this is just another avenue for them to take in payments, to facilitate payments. And Visa and MasterCard are the processing networks for this. So they're the backbone of the system. And so the data is still going to go through them. They're still going to collect their tolls. And it's really the American Express or Discover who have this closed system. You use their card. It uses their own processing network. They handle the funds behind the scenes. All of the traffic has now shifted away from them. So someone with an iPhone is going to use Apple Pay. It still interfaces with MasterCard, and it could even go to, Monroe Bank and Trust if they're hooked into the system. So everyone still they still get to process payments and take their cut, but it's really the American Express and Discover that are cut out.
Okay, all right. We've been on the line with Nate Tobik. He's the founder of CompleteBankData.com, giving us a great look at the banking sector, big banks, small banks, medium-sized banks. Nate, we really appreciate it. Have a great weekend. We hope to talk to you again soon.
Thanks for having me on again. Appreciate it.